Welcome. Today, we're diving into the essentials of Malaysian partnership tax computation using a real-life example. We'll walk through how a partnership's income is calculated, how profits are divided among partners, and how each partner's tax liability is determined. Whether you're a business owner, accounting student, or just curious about tax, this video will break down the process step by step, making it easy to follow and understand. Let's get started by introducing our case study, XYZ Partnership, a Malaysian resident business providing engineering services with three equal partners. XYZ Partnership is a Malaysian resident firm specializing in engineering services. The business is owned by three partners who share profits and losses equally, each holding a one-third stake. For the year of assessment 2024, the partnership's financials and tax-related details provide a perfect illustration of how partnership taxation works in Malaysia. Let's look at their profit and loss account before any tax adjustments are made. Starting point for tax computation is the partnership's net profit. For XYZ Partnership, the net profit before tax adjustment stands at RM 360,000. This figure is crucial as it forms the base for further tax-related calculations. However, not all expenses and incomes are treated the same way for tax purposes, so adjustments are necessary to arrive at the correct taxable income. Compute the adjusted income. Certain expenses must be added back to the net profit because they are not deductible for tax purposes. For XYZ Partnership, these include depreciation of RM 25,000, partner salaries totaling RM 50,000, and the disallowed portion of entertainment expenses, which is RM 6,000. These add-backs ensure that only allowable expenses are deducted, aligning the profit figure with tax regulation. Not all expenses are added back. Some, like staff wages of RM 80,000 and general expenses of RM 40,000, are fully deductible. These costs are considered necessary for running the business and are allowed as deductions when calculating the adjusted income. This distinction between deductible and non-deductible expenses is key to accurate tax computation. Let's calculate the adjusted income. Starting with the net profit of RM 360,000, we add back non-deductible expenses, RM 25,000 for depreciation, RM 50,000 for partner salaries, and RM 6,000 for entertainment. The total add-backs amount to RM 81,000. Therefore, the adjusted income is RM 360,000 plus RM 81,000, resulting in RM 441,000. Capital allowances are deductions allowed for the wear and tear of business assets. For the year, XYZ Partnership claims a capital allowance of RM 45,000. This amount is subtracted from the adjusted income to arrive at the statutory income, which is the figure used for further tax calculations. Now let's determine the statutory income. We take the adjusted income of RM 441,000 and subtract the capital allowance of RM 45,000. This gives us a statutory income of RM 396,000. It's important to note that interest income from Malaysian banks, amounting to RM 4,500, is exempt and not included in this calculation. Approved donations can be deducted from statutory income, but only up to 10% of aggregate income. For XYZ Partnership, the statutory income is RM 396,000, so the maximum allowable donation deduction is RM 39,600. Since the actual donation is RM 9,000, the full amount is deductible. This brings us to the next step, calculating divisible income. Divisible income is the amount left after deducting approved donations from statutory income. For XYZ Partnership, we subtract RM 9,000 from RM 396,000, resulting in a divisible income of RM 387,000. This is the income that will be allocated among the partners according to their profit-sharing ratio. XYZ Partnership, profits and losses are shared equally among the three partners. This means each partner receives one-third of the divisible income. With a total divisible income of RM 387,000, each partner's share is RM 129,000. This allocation forms the basis for each partner's individual tax computation. Let's break down the allocation further. Each partner receives an adjusted income share of RM 147,000, a capital allowance share of RM 15,000, and a donation share of RM 3,000. After these allocations, each partner's statutory income is RM 132,000, and their taxable partnership income is RM 129,000. Each partner's taxable income from the partnership is RM 129,000. Since the partners have no other sources of income, this amount will be used to compute their individual tax liabilities for the year. The next step is to apply the Malaysian individual tax rates for the year of assessment 2024. Malaysia uses a graduated tax rate system for individuals. For the year of assessment 2024, the rates start at 0% for the first RM 5,000 and increase through several bands, reaching up to 25% for income above RM 100,000. Understanding these bands is essential for accurate tax computation. Let's apply the tax bands to each partner's income of RM 129,000. The first RM 5,000 is taxed at 0%, so there's no tax here. The next RM 15,000 is taxed at 1%, resulting in RM 150. The following RM 15,000 is taxed at 3%, which is RM 450. The next RM 15,000 is taxed at 6%, totaling RM 900. Continuing with the calculation, the next RM 20,000 is taxed at 11%, resulting in RM 2,200. The following RM 30,000 is taxed at 19%, which is RM 5,700. Finally, the remaining Rm 29,000 from Rm 129,000 minus Rm 100,000 is taxed at 25%, totaling Rm 7,250. Adding up all the tax amounts from each band, we get the total tax liability for each partner. The sum is Rm 0 plus Rm 150 plus Rm 450 plus Rm 900 plus Rm 2,200 plus Rm 5,700 plus Rm 7,250, which equals Rm 16,650. This is the amount each partner will need to pay for the year of assessment 2024. Recap: the statutory income of the partnership is Rm 396,000. After deducting approved donations, the divisible income is Rm 387,000. Each partner's share of divisible income is Rm 129,000, and the individual tax liability per partner is Rm 16,650. These figures summarize the entire tax computation process for XYZ Partnership. It's important to note that XYZ Partnership had no brought forward losses or capital allowances from previous years. This simplifies the computation, as all calculations are based solely on the current year's figures. Partners also have no other sources of income, making the allocation straightforward. Proper allocation of partnership income and tax ensures fairness and compliance with Malaysian tax laws. Each partner is taxed individually on their share, preventing double taxation at the partnership level. This system also allows partners to plan their finances and tax payments more effectively. Summary: Malaysian partnership tax computation involves several clear steps: adjusting net profit, applying capital allowances, deducting approved donations, and allocating income among partners. Each partner's tax liability is then calculated using individual tax rates. Understanding this process is vital for business owners and professionals alike. Thanks for watching, and we hope this breakdown has clarified the essentials of partnership tax in Malaysia.